How much money should you have by age 25? It's the question everyone whispers about, but nobody seems to have a straight answer. You scroll through social media, and it feels like everyone your age is either buying a house or traveling the world, making you wonder, what am I doing wrong? But here's the secret. The real answer isn't a magic number. It's about the habits you build. Why is age 25 such a big deal financially? For many of us, it's a major turning point. You might have just landed your first full-time job, which means a stable income for the first time. You're becoming truly independent, facing real financial responsibilities like rent, bills, and maybe even student loans. The financial habits you form right now are the foundation for your entire future. Think of it like this. Your 20s are for building the skyscraper, not just admiring the penthouse view. Let's bust some common myths right away. Myth number 1, you have to be rich by 25. Absolutely not. This idea is a recipe for anxiety. Myth number 2, everyone should have the same amount saved. That's just impossible. Everyone's life circumstances are different. The biggest myth of all is that you should compare yourself to others. Comparing your financial chapter 1 to someone else's chapter 10 is the fastest way to feel discouraged. Your journey is your own. So, what's a realistic financial picture at 25? Instead of a huge bank balance, let's focus on 3 key pillars. First, an emergency fund. This is your financial safety net. Aim to have 3 to 6 months' worth of essential living expenses saved up. This isn't your vacation fund. It's for true emergencies like a job loss or an unexpected medical bill. Second, try to have no high-interest consumer debt. I'm talking about credit card debt. If you have it, making a plan to pay it down should be your top priority. Third, and most importantly, establish a basic savings habit. Even if you're only saving a small amount from each paycheck, the act of consistently putting money aside is what builds momentum. Okay, I know you still want some numbers, so let's talk about general benchmarks. Having anywhere from $1,000 to $5,000 saved is a fantastic start and puts you in a solid position. Another great target to aim for is having 1 month's gross income in your savings account. So if you make $3,000 a month, having $3,000 saved is a great milestone. But remember, these are just guidelines. The key is to focus on your personal progress, not on achieving perfection overnight. If you only have $100 saved, your next goal is $200, not $10,000. Ultimately, what matters way more than the exact amount in your account are your financial systems. Are you saving consistently, even if it's just a little? That habit is priceless. Do you have a budget? Knowing where your money is going is the first step to telling it where you want it to go. This isn't about restriction, it's about control. And finally, are you building your financial awareness? Are you learning about money, reading books, or watching videos like this one? Financial literacy is a skill, and it's one of the most valuable you can develop. Now let's talk about the I word, investing. It can sound intimidating, but at 25, you have the most powerful asset on your side, time. You don't need to be an expert or have a lot of money to start. The biggest mistake people make is waiting until they feel they have enough money to invest. Starting with small, consistent investments in your early 20s can grow into a massive nest egg thanks to the power of compound interest. The money you invest at 25 has decades to grow, work for you, and multiply. So start learning the basics now. As you build these great habits, there are a few common mistakes you'll want to avoid. The first is lifestyle inflation. This is when your spending increases every time you get a raise. You finally start making more money, but you end up with nothing extra to show for it. Instead, when you get a raise, try to save and invest at least half of that new income. Another mistake is ignoring your emergency fund. It's not the most exciting goal, but it's the most important. Don't start investing heavily until your safety net is in place. And finally, avoid chasing status. Don't buy things you can't afford just to impress people. True financial security is about stability, not showing off a new car or expensive clothes. It's crucial to remember that everyone's situation is different, and that's okay. If you're a student, your financial picture will look completely different from someone who's been working full-time for 3 years. If you're supporting your family, your savings goals will be different from someone living alone. Some people graduate with no debt, while others have significant student loans. Your path is unique. The only person you should be competing with is the person you were yesterday. Focus on your own lane and your own progress. All right, let's dive into what truly matters more than the exact dollar amount in your bank account by age 25. Seriously, forget the numbers for a second and focus on this: building consistent habits. Are you consistently saving something, anything, from every paycheck? Even if it's just $20, that habit is more powerful than a one-time lump sum. Why? Because habits stick. They become automatic. Next up is budgeting and having control over your spending. This doesn't mean you can't have fun, it just means you know exactly where your money is going. You're the boss of your finances, not the other way around. Using a simple app or even a notebook to track your income and expenses gives you incredible power. It helps you see where you can cut back a little, so you can put more towards your goals. Finally, it's all about financial awareness. This means you understand the basics of things like interest rates, how credit cards work, and what a 401k is. You don't need to be a Wall Street genius, but you should be curious and willing to learn. Being aware is the first step to making smart money moves. These three things, consistent savings, budget control, and financial awareness, are the true foundation of wealth, way more than hitting a specific number by 25. So now that we've covered habits, let's talk about the big one: investing. The thought of investing by 25 can be intimidating, right? It sounds like something you do when you're rich. But that's a huge myth. The most important thing you can do by 25 is simply start learning the basics. What's a stock? What's an index fund? What's a Roth IRA? You don't have to invest a dime yet. Just start consuming information. Watch videos, read blogs, listen to podcasts. Knowledge builds confidence. Here's the secret weapon you have at 25: time. A small amount of money invested today has decades to grow, thanks to the magic of compound interest. $100 invested at 25 is way more powerful than $1,000 invested at 45. So, starting with small investments is infinitely better than waiting until you have more money. You'll never feel like you have enough money to start. The key is to just begin, even if it's with a small automated investment of $25 or $50 a month into a simple index fund. Your future self will thank you for it. Of course, as you're building these great habits, there are some common money traps to avoid, especially in your 20s. The number one mistake? Lifestyle inflation. This is when your income goes up, and your spending goes up right along with it. You get a raise, so you get a fancier apartment, a newer car, and eat out more. Suddenly, you're making more money, but you're just as broke. The trick is to intentionally save and invest a portion of every raise or bonus before you get used to spending it. Another huge mistake is ignoring your emergency fund. It's not exciting, I get it, but that fund is your financial safety net. It's what keeps a flat tire or an unexpected medical bill from becoming a full-blown financial crisis that sends you into debt. Chasing status instead of stability is a related problem. Feeling pressured to buy the latest phone, designer clothes, or take lavish vacations to keep up with what you see online is a recipe for disaster. Real financial security is silent. It's not about what you show, it's about what you have saved and invested. Now, it's super important to acknowledge that everyone's situation is different. The financial path of a student buried in loans is going to look completely different from someone who started a full-time job at 18 with no debt. Are you living at home, or are you paying rent in an expensive city? Do you have family members you need to support financially? These factors dramatically change what's possible. Someone working part-time while studying might be focused solely on keeping debt low and maybe saving a tiny emergency fund of a few $100s. Meanwhile, someone earning a stable income might be aiming for that 3 to 6 month emergency fund and starting to invest. Your journey is your own. There is no one-size-fits-all benchmark, and comparing your behind-the-scenes reality to someone else's social media highlight reel is the fastest way to feel discouraged. Focus on your own lane, your own progress, and your own goals. That's the only comparison that matters. So, let's bring it all together. How much money should you have by age 25? The honest answer is, there is no magic number. It's not about having 10,000, 20,000, or any other specific amount saved. It's about the systems and habits you have in place. By 25, the goal is to have a basic budget, to be saving something consistently, to have started an emergency fund, and to have a plan to tackle high-interest debt. The most important thing is that you've started. You're aware, you're trying, and you're moving in the right direction. Building good financial habits now is what will truly set you up for success. Don't get stressed about the exact balance in your account. Start where you are, with what you have, and just stay consistent. Your financial future isn't defined by one age, it's built day by day. So, let's talk about some realistic money breakdowns for a 25-year-old. Forget those crazy numbers you see online. The first and most critical thing is your emergency fund. This isn't your vacation fund or your new phone fund. This is your life just happened fund. Your goal should be to have 3 to 6 months of essential living expenses saved up. Calculate what you need for rent, utilities, food, and transportation. If that total is $2,000 a month, you're aiming for $6,000 to $12,000 in a high-yield savings account. This is your financial safety net, and it's non-negotiable. Next, let's talk about debt. The biggest goal by 25 is to have no high-interest consumer debt. I'm talking about credit card debt. That stuff is like financial quicksand, with interest rates often over 20%. It's almost impossible to build wealth when you're paying that much just in interest. Student loans are different. They usually have lower interest rates and are considered good debt if they led to a higher income. But that credit card balance from a shopping spree? Pay it off as aggressively as you can. Being debt-free from high-interest loans is a bigger win than having a huge savings balance. Finally, the most important thing is establishing a basic savings habit. It doesn't matter if you start with just $20 a week. The habit is more important than the amount. Set up an automatic transfer from your checking to your savings account right after you get paid. This pay yourself first strategy ensures you save before you have a chance to spend it. By 25, this should be a reflex, not an afterthought. These 3 things, an emergency fund, no high-interest debt, and a consistent savings habit are the real signs of financial health at 25. So what are some actual savings benchmarks? Remember, these are general guidelines, not strict rules. If you have between $1,000 and $5,000 saved by 25, you are off to a solid start. This shows you have the discipline to put money aside and are building a foundation. A really good target to aim for is having 1 times your monthly income in savings. So, if you make $3,000 a month, having $3,000 in savings is a fantastic milestone. It gives you a buffer and shows you're living within your means. But here's the most important part. Focus on progress, not perfection. Don't get discouraged if your friend has $10,000 saved and you only have $1,000. Maybe they live at home or have a higher paying job, or don't have student loans. Your journey is your own. The goal is to be in a better financial position this year than you were last year. Are you saving more consistently? Are you paying down debt? That's what matters. Your net worth isn't a race against others. It's a marathon you run with yourself. Celebrate your small wins and keep moving forward. Let's dig deeper into what truly matters more than the exact amount in your bank account. First up, consistent saving habits. Seriously, someone who saves $100 every single month without fail is in a better position long-term than someone who saves $1,000 once and then nothing for the rest of the year. Consistency builds momentum. It trains your brain to prioritize saving. It's like going to the gym. You won't get fit by doing one massive workout and then quitting. It's the small, regular workouts that build strength over time. Your finances are the exact same. Next is budgeting and spending control. You can't save what you don't have, and you won't have anything left if you don't know where your money is going. Budgeting isn't about restricting yourself. It's about giving yourself permission to spend on what you value. Use an app, a spreadsheet, or even just a notebook. Track your income and expenses for a month. You will be shocked at where your money is actually going. That daily $5 coffee? That's $150 a month. Those subscriptions you forgot about? Another $50. Knowing this gives you power. You can then decide, is this worth it? Or would I rather put that $200 toward my emergency fund or a vacation? This control is freedom. And finally, financial awareness. This means you're actively engaged with your money. You check your bank account regularly. You know your credit score. You understand the interest rates on your debts. You're not afraid to look at your financial situation, even if it's not perfect. So many people live in a state of financial anxiety because they just ignore everything. They're afraid to open their bills or check their balances. But ignorance isn't bliss. It's just delayed panic. By 25, your goal should be to face your finances head-on. This awareness is the foundation upon which all other good money habits are built. Now let's touch on a topic that scares a lot of young people: investing. The word itself sounds so adult. But here's the secret: you don't need to be a Wall Street expert to start. Your goal by 25 isn't to be a stock market genius, it's just to start learning the basics. Read a book, watch some reputable YouTube channels like this one, or listen to a podcast about personal finance. Understand simple concepts like index funds, ETFs, and the power of compounding. Knowledge is the first step, and it costs nothing. The biggest mistake people make is waiting until they have more money to start investing. This is a huge trap. Starting with small investments is infinitely better than waiting. Even if you can only invest $25 or $50 a month, do it. The habit and the experience are what you're after. Many brokerage apps now allow you to buy fractional shares, so you can own a piece of an expensive stock for just a few dollars. Getting started demystifies the process and builds your confidence. Here's why starting early is so critical. Time is your biggest advantage. It's a superpower that even the richest people in the world can't buy more of. This is because of compound interest, where your investment earnings start generating their own earnings. For example, a single investment of $5,000 at age 25 could grow to over $100,000 by age 65, assuming an average 8% return. If you wait until age 35 to invest that same $5,000, it would only grow to about $47,000. You lose more than half the potential gains just by waiting 10 years. So don't wait. Start small, start now, and let time do the heavy lifting for you. Of course, as we build these good habits, it's just as important to avoid common mistakes. The number one trap for people in their early 20s is lifestyle inflation. This is when your spending increases every time your income does. You get a raise, so you immediately get a more expensive apartment, a fancier car, or start eating out more. Suddenly you're making more money, but you're still living paycheck to paycheck. The key is to inflate your savings and investments rate, not just your lifestyle. When you get a raise, commit to saving or investing at least half of that new income. This is how you actually build wealth.